I'm going to just start out with a few update charts about what's going on in the market so that when we go through the details of the technical stuff, that it kind of will make a little bit more sense why we do what we do. First thing I want to update you guys on, the very first slide of the very first presentation I gave, I wanted to just put in the context, this bull market in stocks that we were in. At the time, we were in the third longest running and the second highest magnitude bull market move, meaning where all stocks together were all going up at the same time. Since that time, we've actually eclipsed the second running, and we are now in the second longest bull market in history without at least a 20% drop. Now back in February, depending upon which way you measure what the stock market is, which are indices, it got almost to about 20%. It was about 16 in some of the low cap stocks. But essentially to the same measurement that we have used in the professional community for quite some time, we still have not seen an official bear market correction. Next thing, this might be the most important thing we talk about tonight, interest rates. Interest rates. So what's funny about this is when interest rates started to get really low, maybe a year ago, a couple analysts who thought they were clever would say, oh, in 30 years, this is the lowest we've had, interest rates we've had. And then some guy would go, well, in 100 years, this is the lowest we've ever had. And then some guy went to some archaeological reports, and he found some data from Homer and Celia's history of interest rate document. I don't know what language that could have been in. But essentially, we are at the lowest interest rates in human recorded history. So that is something that we'll definitely talk about a lot tonight, and how that affects my outlook, but also what does that mean for us as investors. The next thing I want to talk about is why interest rates are so low. What is basically the biggest driver of most interest rate markets? It's central banking. So central bank intervention or open market operations is a huge driver why interest rates are so low. Essentially, in order to get interest rates to go lower, central banks together have coordinated an effort to purchase bonds, to basically buy government bonds so high up that they just have no interest, and some actually have negative interest. So that sounds very weird to some people. What negative interest rates? What does that mean? I mean, if you think about just the simplest savings account, you would go to a bank, deposit some principal into account, and then that rate that they decided upon, they would pay you your principal plus interest in the future, right? Simple concept. This is the opposite. You go to a bank, you give them your money, and they promise to give you less money in the future. So this is a very peculiar times. Another thing that is sort of a spurious correlation is the relationship between all this buying and in the bond markets and stimulus, so to speak, and the US stock market. So as we talked about in previous presentations, when the Federal Reserve stopped QE, which is the red line, you could see that's when the stock market really started to go sideways or just started to drift. It no longer had a full upward move. Well, what this graph shows is it shows the balance sheet of the Federal Reserve, the Bank of Japan, the European Central Bank, and I think it's a Swiss National Bank, this one right here, all together. So, we are very aware of what the banks are doing, and it's starting to become pretty clear on how this affects investors and investments. So in February, when the balance sheet was going flat, you guys remember we were in a full safety position in our models, meaning we were almost 100% cash or in cash. This is because there are certain behaviors in the market that we monitor, and when these things start to happen, they trigger a risk management signal to us, and that tells us that we need to take a safer position. And we will hold that safe position until the market, again, changes in a way that tells us that it's more safe to be invested. So the last few times that we've had such a huge rise in the bank's collective balance sheet, it's actually been pretty good for stock prices. So regardless of what people say, good or bad the Fed is, this is something that we're very aware of and are taking into account when we're taking risks in the models. So who's in charge of this boat? Who's the captain of this fleet? Who is basically helming this ship? This lady right here. So she was appointed, and not a lot of people know this, to the Federal Reserve's Board of Directors, which is essentially like a company's board of directors where there's multiple people that get together and make the primary decisions. And she's been serving on the board, and then so often, I think it's 4 to 6 years, they always stagger it a bit from the presidential election. The president standing elects the next board of, or the chairman of the Federal Reserve. He's not really allowed to elect anybody other than who's on the board of directors, so it's not really an election, so to speak. He basically just says who's next in line. But she was appointed by none other than Billy Boy in 1993, and she is now in charge. So when the Fed makes decisions on whether or not to buy bonds, sell bonds, change interest rates, anything they do with their monetary policy, which is relatively limited, it's she who is the last person to sign off on that. So arguably, a lot of economists like myself would almost say that she might be the most important person in this election, not necessarily Donald Trump or Hillary Clinton. And I don't want to speculate on any ties, but she was appointed by a Democrat who is related to Hillary Clinton as well. So I don't know really what that means quite yet, but what I do is I take very, very close attention to what the Federal Reserve says officially, meaning they release their Fed minutes. Every time they have a meeting, they usually have it every quarter, maybe even more frequently than that. And the kind of biggest topic of discussion for people who are monitoring the US interest rate markets is it possible for the United States to have negative interest rates? It's never happened before. It's happening now in Europe and in Japan. So in February, this is kind of how this little story started to go. In that meeting's minutes, she said something to the effect of, "We have not fully investigated the legality of negative interest rates." So I thought that was curious because at least they were acknowledging that it's possible. In May, in the minutes, they said, "Well, we're unwilling to state whether the Fed has legal authority to go negative." So they were sort of humoring that it's even more possible, but something in this process is out of their hands. Maybe the judicial system was limiting to how they could do this. And then in June, when the whole Brexit situation started getting really tumultuous, the minutes basically said, yeah, no doubt the Fed could legally go to negative interest rate policy. So this is something that's neither good or bad. It's something that's happening now and that we're very aware of, and we have basically strategies in place where if this does happen, certain changes in the bond portfolio need to happen, or there's no reason to sit in a negative interest rate type of allocation. So I just wanted to kind of point that out as far as something that's really important to think about going forward.
Alex,
Yes.
does that affects definitely cash sitting in the bank?
Correct.
Does that affect cash sitting in a stockbroker such as what we use?
So when we're in cash, we're actually not technically in like cash dollar bills, we're in money market. So money markets for many years have really paid almost zero interest. So it's not going to affect it that much. I mean, it might squeeze it another 0.03 of a point down, but it's really an unnoticeable effect. The thing that it will affect is essentially the risk-free rate. So in any type of portfolio theory, every type of investment is compared to what is considered risk-free, treasury bonds, right? It's never defaulted, and it's backed by the US federal government. It's the safest investment on the planet, and in any model, you don't really know the value of anything, any stock, bond, any emerging market, anything, unless you compare it to the treasury bond. So it's kind of the staple to how we measure risks. So that's kind of the argument. If they take the risk-free investment down past zero to negative, it really has some interesting possible distortions in the rest of the market. Not all of them could be negative, not all positive, but as you can see right now, Europe's kind of in a mess, and it's really not doing much to their stock market. Their stock market's actually going up. So it's very interesting to see these effects. But what does this mean for us as investors, really? Well, like I said, fixed income as a primary source of investment returns just might not be there. So we have to just be prepared for different allocations. We've actually already kind of done that with allocation to high-grade U.S. corporate bonds, which is basically the next best thing. It's a least risky fixed income instrument. But also, what this tells us something about where we are in this business cycle. And so the business cycle has 4 stages that I spoke about in the first presentation, but essentially that the areas of the stock market that provided the best returns the last basically couple years, these hyper growth companies, these FANGs, these companies that basically have no earnings, they're technology disrupting companies, but they have yet to prove their profitability. Those will most likely not be the best places to invest going forward. But despite all of this, the fundamentals are essential elements of prudent investing, no matter what business cycle you're in or what era you're in, or interest rate regime. And the things we're going to really dive deep into today are just these 4 but definite pieces of our philosophy here in our investment strategies. 1, risk control. I'm not going to go too deep into this because I had a whole presentation about an hour long that was recorded in January, but I'll touch on this very briefly. I also talked in one of those presentations about dividends and the importance of what dividends are. If you think about it, what is a dividend? A dividend is the company paying the shareholder for owning the stock, right? It's sort of an essential element of investing that kind of gets lost in the investment world because it's not really a sexy idea. It's not something that involves stock prices flying all over the place. But there's a lot of things we can tell from a company that has a dividend and has had a dividend for a long time. And we'll talk about that in a few slides. But moreover, the things we're going to focus a little bit more on today and how that fits into the strategy is volatility, what it is and how it works, and then value. Again, we talked about that in the last presentation. So the mathematics of risk control in the simplest form is this. When an investment or an account goes down, has a drawdown, say 15%, in order to get back to even, so where you're square at where you started before, it actually needs to go up 17%. And as you go further down in the drawdown, you need to make back much more gain in order to get back to even. This is the key thing to understand why our strategy is so different than any other strategy out there, is because it's fully designed to take this as the most paramount portion. Controlling risk, preventing permanent impairment of capital is the #1 most important thing in our process. Just to put things in perspective, if you were just in the S&P 500 stock index, if you take the last 50 years and you looked at the worst average drawdown, just the average drawdown for any part of the year, it's around 14%. So that's sort of the benchmark. And our models are designed to have a much more shallow drawdown than that in every environment. So just want to put that kind of in perspective. That's going to be always involved in our process and will always be an overlay. Why dividends matter, total return versus nominal return. This is something that still amazes me to this day. People don't really get, even professionals that have been in the industry for years and years and years. If you look at from 1940 to today, 90% of the total return, almost all of it, has come from reinvesting dividends from the index. So if you just bought the stocks and threw away the dividends in the garbage, you would only have made $10,000 in over 80 years. Whereas if you had reinvested dividends, it's logarithmically higher. Meaning dividends play a huge portion of the investment process. Now this is something we really focus on, we've always focused on, and we are just evolving a bit to be a little bit more efficient. But essentially, what does a dividend tell you? If you have a company and you're looking at a bunch of them, and a company has a dividend, where do dividends come from? Profits. They make money, and then they have to return it back to the shareholders. Well, if a company has had a dividend for 10 years and it's been steady and growing, it tells you very simply they're having bigger profits and their company is growing. So by looking at companies that have dividends, it really does a lot of the weeding out process for us, because for them to continue issuing dividends into the future, their management has to act with much prudence. They have to make sure that the decisions they make with the capital they have will enable them to continue paying that into the future. So it already gives you a sense of quality when you're looking at a company on how their dividends performance have been. Why value matters. So we went really in depth on this last presentation, but essentially there's two types of stock investing in terms of category. There's value and there's growth. And there's many different shades in between, but there's basically two different types. And so we very much fall upon this value line. And again, I'm like a data file. I love data. Data junkie. I go back as far as I can, because I want to know the truth about what did the history show us. So there are times in history where growth does outperform value, but it's very brief. And over the long run, value does much, much better, around 4% more. So we'll talk about the differences there. The things we do know, this is a graph. It's a little complicated to read, but I wanted to show you guys, well, what happened last year? We talked about growth stocks did much better. So these stocks that are priced way above their earnings, they're hyper growth companies. Well, there's only been 5 times, actually 6 times since 1945 where growth companies actually outperform value style companies. And there's 2 things that I got from this when I put together this data. One, it doesn't last very long, maybe a few years, where this part of a business cycle where the growth companies outperform value companies. And then the second portion, which makes me tremendously positive about our strategy going forward, is that when value comes back, when it starts to outperform growth, it does so very quickly. So it outperforms by a huge amount in a short amount of time. So we are positioned very favorably going into this next, decade, because value has yet to perform. It's not there yet. So another layer on this is volatility. Now, you hear about volatility in the news, you read in the newspaper, you read in magazines. What really is volatility? Sometimes this mathematical concept is kind of hard to visualize. And so I always like to reference studies, because this is kind of how the basis of most our process is developed, is on empirical evidence. And so this was a study done by the Yale Endowment. They have done many different types of studies like this, and it's been confirmed by other companies. But what they did is they basically said, let's create a portfolio of stocks that have the lowest volatility. And then let's just buy those, no matter what they are, and hold them for a year. And then we'll do that again and again and again. And then they did that with the highest volatility stocks. So just looking at volatility, well, low volatility is not only a smoother ride, it makes much more money over the long term. So you'll see why that's incorporated into our strategy in the next couple slides. So I wanted to show this because people go, what is volatility? This is volatility. This is what it looks like. It kind of looks like earthquake tremors or something of that sort. It's really just a measurement. It's a standard deviation of the annualized return, or in simpler speak, the rate of which prices move up or down. That's it. It's just normalization of that. So this is part of one of the pieces in the science behind our model's algorithms, and we utilize it every day and we monitor it every day. Any questions there on volatility? So a couple clients came in, and I think she was a little worried because some of the things I was writing in the newsletter and some of the things we were talking about in the meetings, it made her feel like we were changing everything. And I wanted to kind of have this slide to really simplify that. Yes, we're making some changes, but a lot of the foundations that John had originally had you guys invested on within these models are just being improved because those foundations, dividends and indexing to large cap stocks, are really some of the best performing ones over time. So before we were using a few different products to get dividends index. We were actually equally weighting, which in a sense is not a bad strategy, but we have feeling that we could do much better than this going forward. And then we had risk control, meaning when the market started to fall apart, we were just get out. We wouldn't sit through big declines. So now we're using the same concept, still focusing on dividends. We're adding a component of volatility, we're adding a component of value, and we still have risk control. So that's going to be important to understand. So before, what we were doing is we were just taking the S&P 500 and we were taking the top 5 dividend paying stocks in that index. We were basically equally weighting in each sector. And this is something that in the portfolio management industry is called an unintelligent model, meaning not to demean being intelligent, but it assumes that we are not smart enough to predict which sector is going to do better over the next period, so let's just bet on all of them equally, and over time, we'll do fine. That's the 50 stocks equally weighted, and then the risk control component. So in the process of investing the growth portion of our portfolio, we have a very similar process, very similar initial process. We take the S&P 500, we take the top 75 dividend paying stocks, so a little bit bigger basket, and then we take the 50 stocks with the lowest volatility. And remember what volatility means, just the lowest movement. They are the most stable stocks. Annualized rebalance. So all with the same risk control. So you can see it's not all that much different. This was the original model, equal pieces to each sector. And what we're doing now is we're just favoring the sectors that have the lowest volatility. So we're just putting more capital to use in those sectors that have the lowest movement. So why are we doing this? We're doing this because in any manager's goal is to get more return for less risk. That's all this huge amount of research and science is always trying to do. Take less risk and to get more return. So the S-Dogs is what we were using before, had a volatility of 11. This is just the S&P 500, so every time we look at this, it's because that's the standard. That's what we're measuring ourselves against. And this is the low volatility index, the high dividend, low volatility. So you can see we're taking less risk when we're buying this index. And it's really nothing different other than just buying more or less of some stocks. So what does this look like over long periods of time? Well, this is the S&P 500, again, with no dividends. And this starts in 2000, it just got cut off here. This is the S&P 500 total return. So again, with dividends. This is something called the Aristocrats Index. And that's been around for quite some time, since the mid-90s. And really what that index is just the stocks in the S&P 500 that have 10 years of dividends. So they just haven't ever cut the dividend. Well, the S-Dogs and the low volatility over long periods of time just have a much higher magnitude of potential performance. Again, just with these subtle changes on how much you own in each sector. You could see over a short amount of time, there might be very minimal difference, but where the low volatility index really picks it up is in a more volatile time, just like right now. When the market got really, increased with volatility, this is where the low volatility index kind of starts to scoot ahead. So again, these are indexes. You can't invest directly in the index, but what we do is we model around an index. We take this concept and we put it into action in the portfolio. So this brings us to persistent value. This is what me and John have been working on all year with Parallax. They initially built our model and then we revised it a bit. We looked at the numbers and we said that we wanted something a little bit different. So we kept going forward, but essentially behind this technology, it enables us to do some really common sense things. One, we find and invest in high quality businesses that have earning stability and growth. Remember what dividends mean, remember? And then we buy these companies when their current price is cheap versus their appraised valuation. Simple process. Essentially, we're always looking for asymmetric risk versus reward. Meaning if you, say, go to Vegas and you're playing roulette and you're playing black and red, you only ever have a 48 to, what is it? I think it's 48 to 62% chance of ever winning. So your odds are never in your favor. They're always asymmetric against you. Well, we look at the probabilities and we only implement pieces in the portfolio that have asymmetric risk reward in our favor, meaning if we risk $10, we want to make $60, right? That makes sense. So that's what this next portion is. It's persistently growing profits, persistent and undervalued, persistent value. That's what we're going to talk about that in the newsletter and in your meetings and stuff. So really that's what it means. So last little technical slide on how the algorithm works with the database is we start with the top 1,000 largest US stocks. We screen for companies that have 3 years of steady rising valuations. We look for a stock that is today 30% undervalued or more. We don't buy all of them in one sector, so we spread it out over different sectors, and I'll explain that in some of the slides in the future so you can see why that helps. It basically adds to the fact that we're trying to minimize volatility. Say if we go and the energy sector, most of it's undervalued right now, we just buy all the energy sector. Well, one, we're at the mercy of oil prices, and the stock market might be a high right now. So if we spread it out over time, we'll kind of remove that volatility. The last and most important part that I'll show you in the next slides is we actually know exactly when to sell. This is something that is very unique to our process that I know for a fact the rest of the industry cares nothing about. When to sell. They only care about when to buy and hold forever, and then magically, it'll take care of itself. Every time we make a trade, we add a piece to the portfolio, we know exactly where we will get out if the stock price goes down and starts to create a loss, and exactly where we will get out when we've locked in a gain. And I'll show you some examples of that. Take, for example, if you own a house that's $500,000 and someone comes up and says, man, I really want your house. I'll give you $1 million. Would you do it? Yeah. Of course. And then what would you do with the rest of that money? Maybe buy 2 houses. Maybe buy, do something more productive with that capital. This very simple concept is exactly what we will be doing constantly. We'll always be looking for the next better opportunity and the next asymmetric risk reward profile. So I showed this in the previous slide. It's really just a summary of what comes from the Parallax Financial Research database. And essentially from the tremendous amount of research that they've done, when you take all the stocks in their database that were 30% undervalued or more, you have on average a 15% gain on average. So that's a lot of them together. So it makes our asymmetric reward much better than just owning the market. We have a potential to make at least a 6% over just the stock market by only working in this area of 30% undervalued. Again, we also want to stay away from stocks that are overvalued, no matter how cool they are. Tesla, Nike, Under Armour. These stocks are overvalued. So they might be good companies, but their asymmetric reward is against us. And that's why we keep changing it.
How many different models do you have for our portfolio? Maybe 4?
There's actually 6, but most people are in 3 of them. Very few clients have the risk tolerance to be 100% in stocks or 100% in fixed income, so it's typically a moderate amount.
When you make your decisions to move, does all models get moved at the same time?
Correct. So what I do is when I make a trade to buy a stock, I call up a trade desk, TD Ameritrade, and they make a trade for everybody's account at the same price. And that way, it's obviously fair for everybody, but that's compliance-wise, we have to do that. So there's never someone getting it $1 more or $1 less. It's all traded in one block, and that's pretty standard nowadays with the trading technology. It happens pretty much everywhere. So this is something that we show in the newsletter, and something we monitor on a weekly basis. It's basically a full scan of the market carpet. And John likes to say some things about this graph because it means a lot to our process and our philosophy.
Let's say that all of us tonight, we're going to go out and buy a house. And we had a budget of $300,000 for the house. And every one of us found a house we like for $300,000. Which one of us will write a check for that house before we get it appraised? You wouldn't think twice about that, right? But the entire investment world buys stocks without getting an appraisal on it. Matter of fact, we buy them the way Wall Street sells them. If it's going up in value, it's more attractive, right? It really doesn't make sense. So some of the jargon you hear that you actually use doesn't make sense. How many of you want to be fully diversified in the market? Okay, let's talk about that for a second. So that's incorrect. I'll tell you why it's incorrect. This chart here shows different sectors of the market. You see where there's a negative number here? A negative means it would have to drop by that much to be fair or equal value. It's that much overpriced, okay? So if you had $1 million to invest, would you want to spread it evenly over all these grades right here? I mean, it's not hard to figure out, but we've been told that. And why have we been told that? It's easier for the institutions. You have to understand this business. We are small compared to these big institutions, and that's our biggest advantage. We can do things they can't do. So take, for instance, the stocks we've recently bought. Almost all of them have been, we bought four stocks this month. All but one of them has been in an undervalued area. So what does it also say? Did we go buy something up here in discretionary that's just, we had to fit it in? Since we didn't want it all in one spot, we just went and bought something else. Did we do that? No, we did the math. This is all an algorithm. So we find a stock within that sector that is a true value. So at the end of the day, it's about math, y'all. It's not about who the executive is. It's not about the government. All the things I often hear y'all talk about, and I try to give you a blank face when I hear it. I just don't buy it. I don't care what Saudi Arabia is thinking. I care what they're doing. I don't care what the stock might be, what it is doing. So I really, really think this is important to understand. Now here's the other very difficult part. This information, where do you get this from? Where?
Performance?
No, you can't get it. None of y'all can get this. Merrill Lynch can't get this.
How do you get it?
I pay a lot of money for it. So Alex, my good employee here, is a market technician, and he had introduced me to a firm, a Parallax, that does this for 20 hedge funds around the globe. And so he came on telling me about it. As I looked into it, the more I liked it, and then I understood why I need to lock it a lot, because it was a whole lot of money. But at the end of the day, the more we know, the better we go, right? So you find people making mistakes, they just don't know enough. And so I went with Alex up to, where did we go to?
Sun Valley.
Sun Valley. That was a little interesting aside there. Chris Coppins will come speak, the man who owns Parallax. And he is an engineer and just really a very smart guy. We got there that night in a condo, and Alex and I, he picked us up at the airport, and we get to the condo, and they're nice condos, right? And Alex and I are led up to the second story, and Chris opens the door and goes, "Here's your room, guys." Us together. There's some other guys sleeping in the bottom bunk. So Alex slept in the top bunk, I slept in the bed, and I was a little uncomfortable. So heck, we're all in here, so what? Well, the funniest thing about it, I thought it was really odd. I'm thinking, this is really strange. I could have rented a room, and I didn't get a chance to talk to you, but you thought it was odd, didn't you?
Yeah, I thought we were doing a hotel.
There's this little guy there on the bottom bunk. What is his name?
Howard.
Howard, would you agree he's very obnoxious?
Oh, yeah.
We were, me and Chris, and there was 3 or 4 of us in all day long meeting, and Howard just would not shut up. And I think I'm a talker. So, but we're getting ready to go to dinner, and I'm in the bathroom, and Alex goes, "Oh, I can't believe that, huh?" I said, "What? God, I can't get over it." I said, "What?" He goes, "I couldn't sleep last night." I said, "Well, you couldn't sleep?" "Oh my God, I didn't know we were all in the same room." He goes, "God, I couldn't sleep last night. I took 2 Xanax and such, still couldn't sleep." So me being the thinking man, the next morning, I said, he goes, "Look, if I oversleep, you wake me up." I said, "I got your back, pal." So next morning, I woke up, I put my hand on his ankle and up his calf and up his knee. "Good morning, sweetheart." That was my business trip. But the bottom line with this, this information is you have to have the information. And we started implementing this, I guess, in April was the first big shot of it. And when you look at your statements, all y'all coming in for your next quarterly meetings, I'm going to draw your attention to the line of volatility. Because as you look at your third quarter statements, you're going to see your portfolios went like this, and the other markets did a whole lot of this like that. And that's very, very important. We've been able to minimize that volatility. And in third quarter, our Model 3 and Model 4, I can remember, we outperformed all the benchmarks, but we had 31% of the money in cash. But none of that was from us doing any stock picking. We get together and think this is a great stock. It's all from a mathematical basis. So when Alex first interviewed, we had a different conversation you are having right now. Because Alex wasn't in the defensive mode that I am with investing. Because Alex has been consulting hedge funds, and if you got $500 million or $400 million, you've got $500,000 invested in a hedge fund, you can live through some volatility to make the great return. That's why Alex said, dude, our clients can't do that. We can't go have a 35, 40% drop. And so that's part of what took us some time to get our model, because when I talked to Chris, I said, we just can't have it. I said, make these people every quarter, they're mom and pop. They're not people that are institutional investors. And so Chris had some comments to Alex, and they were complimentary about the strategy we have. And so we put it into place. And you're going to hear a lot in the newsletter, a lot of the same things. So we want to kind of emphasize that tonight. But just to know this, we have several different measurements as when to get out of the market. But what we don't want to do is be out at the wrong time. Right. You can be so safe that you hurt yourself. The person who keeps their money in their mattress, well, they may not lose it to the market, okay? But they may have bed worms in there, or whatever's going to happen to them. So we have some strategies to get there. But to me, when I first started looking at this from Chris, it really dawned on me. Because if I'm buying a mutual fund for anybody in this room, you know what? I'm buying all this, aren't Alex? If I buy a growth fund, it's going to have a little bit everywhere. And so to get excess performance, what I told Alex and I told Chris, we want for our clients, we don't want to take more risk for more return. We want to be able to get what's called excess return. And that's really how we're grading the job that Alex is doing and Chris is doing, how it's what's worth. And come this October, Chris will come speak, and you're free to tell him about the three of us sleep in the same room, because I've yet to tell him how funny that was to me. I never talked to him about it. Anyway, so I just wanted to really emphasize this. Very, very, very important. And when you come in for your meetings in the next month or two, we're going to print those statements out. I'm going to show you how to look at the volatility, why that matters so much. Because volatility is a measurement of risk.
It's hard to see this, I know, because it's such small, but this is basically our shopping list, our buy list. And there's a lot of value in our model. So every week that goes by, we'll be adding a new position to the portfolio. We'll be spreading across different sectors. But you can see right now of the top 1,000 stocks, there's actually quite a few that have rising profitability, rising valuations. And we're very positive about adding these to the portfolio going forward. Some of these we've already talked about. Some of the interesting ones are obviously Apple's doing well, and the airlines I was actually surprised to see out there, but they are. Here's an example of one that we added. I think this is the first stock we added. Again, we start looking in the most undervalued neighborhood, utility electric power, utilities, and utility sector. This is, again, a company that's in the Russell 1000 for the biggest 1,000 stocks.
When you showed all those stocks, so when y'all go to buy, are you buying any mutual fund or are you buying all stocks?
Exactly. So we don't have anybody else manage our money anymore. We do it all in-house. I'm responsible. Not anybody else in New York, you know what I mean? And that's important to me because we care. Someone in New York with a fund, you come and go from the fund, they don't care. So here's an example of a company that exactly fit our checklist. Undervalued sector, consistent earnings. Here's the appraisal value. So you could see that even though here was overvalued, the earnings have been stable enough to let that stock get in our portfolio. And then right now it's currently undervalued at least 30%. It's actually gone up a little bit since we bought it. But a thing to emphasize is these aren't like speculative small companies. These are the biggest 1,000 companies in the United States. They're very, very large enterprises. This company provides over 1.5 million homes with electricity and gas. Has 20 wind farms and 40 solar farms. So it's kind of an interesting company to add to portfolio. Utility companies typically do very well when interest rates are low, so it just makes little sense. Here's an example of kind of what goes on under the hood. You know, these are the things that I monitor on a daily basis. Here was the signal to that week when we should buy. We didn't have the model on until June, so we essentially bought right about here at the same price. And the thing to notice is that this hatch mark here is a huge amount of science goes behind where to get out and where to get in, but this is essentially our stop loss price. So if the price goes down and it starts to perform poorly, we protect capital by selling out at a loss or at a minimal gain, and we just move on to the next one. You can see here that it also follows behind price as we move into profit. So essentially locking it in, it locks it in. That's very important part of it. Also, the profit target moves. So the reason the profit target moves is because, as with any investment edge, there's really a half-life to these things. So as the valuations change, it automatically adapts that profit target down lower so that we have a higher chance of making some money rather than a lower chance of making a lot of money, right? So it's a bird in the hand versus two in the bush kind of thing. But essentially, this is what is 100% on top of every stock position. This is just stuff to technically about how to enter the position. Here's TDS. It's a telephone data systems. They, again, are competitors in telecom industry, diversified telecom. So they do a lot of different things, cell phones, VoIP, 1.2 million users in 40 different states. So they're just a smaller version of AT&T and Verizon, and they're starting to pick up their profitability. So this is one that added to the portfolio. We've already seen a nice little gain. Again, the stop and the target. This one was added third 2 weeks ago. It's a REIT company. They have 71 million square feet in their real estate trust. They're commercially only focused, and again, a sector that is interest rate sensitive. So when interest rates started to take off, basically get lower and lower, these become more attractive because people buy these companies as a source of income essentially through the rent. So this one's actually got some nice upside to it. This here was a profile that basically it was already in the trade, and if we get this type of thing and it basically signals again to get in right after we've already been in, it allows us to keep riding the stock. So for example, something happened between the trade that it had us in the beginning of the year, their valuations went up, and it said at the end of this trade, when it got to the end, it said just keep holding it, and so it just renewed it. So this is an example of a stock that would just continue to hold in the portfolio. Yes?
Do you also have something that triggers that says we're going to buy more of this stock? Or you just...
You know what it would do is it would try to buy another stock in the same sector, again, spreading out the risk a bit, but we really only want to have around 5% max on any stock. That's kind of built into how the volatility target is. We don't want to have too much. If I was like a concentrated hedge fund manager, which is essentially what I used to consult, they only have like 20 positions, maybe even less, and they really love those positions. Like they just marry that company. So we're kind of in the middle. We're not closet indexers. You know, we actually hold quite a few amount of stocks compared to most, but we have enough that it dampens the volatility. Who watches the Home and Garden TV network? Food Channel, Anthony Bourdain, love that show. We just bought Scripps Networks, broadcasting company, and their valuations are very positive. So I guess all that food network is doing good for them. I don't know if they sell infomercials on this channel, but I think they might. Again, here's the stop and target. So at the end of the day, where's the money? Where's my money? I've heard a few people ask me that. So I just wanted to make a slide that says where it is. And so, you know, primary in a perfect world, when we can, we're going to be focusing on these persistent value companies. Again, these are high quality companies that have proven profits. If we cannot find one to put in the portfolio, Well, what do? We don't just sit out. We want to go into something that is lower risk than the market, the SPHD, or the low volatility index. This has a few advantages. Typically, when there's not a lot of value to be had, the market goes sideways or even dips down. Well, we know that this is a place where we know we're going to get a yield. Every month they'll pay the dividend yield, and that this index typically does better in volatility markets. Now, again, as we experienced in December, if the behavior of the market becomes so fearful and erratic, we will go to cash, or essentially, it's not really cash, it's treasury bonds, the safest place. Because even though they have a very small yield, it's still better than nothing, right? So that's really the circle of life in our strategy. Now I want to do, because I always like to end it with like kind of what I see going forward. I think I keep saying this, but the media has a huge disservice to the common investor because they get their money from ratings. They get their ratings from selling fear and selling doom and gloom. And what they don't tell you is that millions and millions of people all over the globe go to work every single day to make money for their families. They work at companies whose sole job is to produce profits and create rising stock prices. So the triumph of the optimists in the long run, in my view, will always win out. The election, here we go. So I won't tell you who I may or may not vote for because it's not really my place. But all I do is I look at the numbers, and I found some really interesting things to share. And what I did is I took, in technical analysis, we love to do stuff like this where we try to measure seasonal patterns. And so what I did is I took all the 8 years of presidency and made that a line. And then I took that's this line, the pink line. And then I took when no sitting president was running, and I took all those years and averaged them out. And then I took the years where the incumbent party won, so this would be if the Democrats won, and the incumbent party lost. This one here would be if the Republicans win. So right now we're right in here. This was a little while ago when I made this graph, but we're in that summer doldrums period. The market really doesn't do much. It's actually been quite more wild than the summer typically is with Brexit. But essentially, I'm leaning towards this kind of pattern. I mean, you never know what the future's going to hold, but you can look at previous patterns and you can sort of ascertain what may or may not happen. The one thing I do know that it's interesting is more than any other political analyst I'm aware of, the stock market is the most accurate form of predicting who wins the presidency. If you take the 3 months before the election, so what is it, November, October, or September, November, October, November, all the way up to the 3 months, 19 out of 22 times, if the stock market was up, the incumbent won. If the stock market was down, the incumbent lost. So that's pretty good odds. I mean, it's not amazing, huge sample size, but you guys can monitor that on your own, whether or not you think who's going to get elected. On the other note, I know we don't talk a lot about the bond market because really bond investing needs to be boring. That's how you know you're doing it right. If it's any exotic at all, it means that you're taking too much risk than you should be in a lot of ways. But one of the core pieces of our portfolio that we moved into has been doing very well for us, but LQD, you'll see it on your statement, it's just high-grade U.S. corporate bonds. So that's your Coca-Cola, Philip Morris, like these mega companies, they have debt, and they pool it into these funds. And so this serves as a fixed income portion of our portfolio. We bought it kind of earlier in the year twice, and last week had the largest one-year inflow. So more people bought this ever on record. So there's a lot of other managers that got to this idea behind our thinking that this was a good place to be, and we're pretty happy with that. Why is this happening? It's because negative interest rates. These huge pension companies, giant insurance companies, they have to, by mandate, only invest in safe things. They can't buy stocks. They cannot buy REITs. They have to buy bonds. Well, there's no more bonds to be had except for in the corporate market. So I expect this to continue, and I feel like this will be a nice position for us for the next basically 10 years. Precious metals. I talked a lot about why we were adding just a little bit of gold and silver. Gold is up, I think, 8%, and silver is up 30% since we purchased it. Again, very small amount. This portion of the portfolio is always going to be very small because it serves as an anchoring point. It's not meant to be like a return producing asset, but again, other huge managers are seeing this trend, this potential theme, and we had the biggest 1 week inflow in those funds. So pretty happy with that. The first presentation I talked about is you can tell a lot about what part of the business cycle we're in by just looking at the different sectors. This is something we always focus on. This is literally from a textbook I have that I kept from 10 years ago at, basically said, prior to that time, when healthcare, consumer staples, and utilities start to outperform, that's when you know you're in an early recession. So remember, recession does not mean stock market collapse. There's been many recessions in US history where the stock market goes up or goes sideways. It doesn't mean that it's necessarily bad for us. But what it does help us is that when we know we're in this time, we know statistically there's places that do better in a recessionary time, right? So I don't know why healthcare isn't performing. I think it has to do something with Obamacare, but I'm pretty sure that there's something wrong in that area right now. So where is the market, overall market? This I add to the newsletter all the time. And more recently, why did it rally so hard in the last couple weeks? Well, you could see here that after 2008, the banking industry was so regulated. I mean, they went and they threw the kitchen sink at these guys and they said, we want to see everything and we want to make sure you will never do that to us again. You mean the American public. So the Federal Reserve requires all these huge mega banks to do these things called stress tests. So they simulate a bunch of different market environments and they simulate cash withdrawals. They do all these things so that they know that one single bank won't take down the rest of the world. I think this is a really nice thing to have going forward. It gives me peace of mind. But 2 weeks ago, the 31 out of 33 of the biggest banks came out and said that they were cleared on these tests. So this is very positive for them. They were allowed to raise their dividends and they were allowed to buy back their own stock, which is very positive for the stock market. You can see it shot up like a rocket in the last couple weeks. But we don't lose sight of the fundamentals. In the overall market, again, this is taking all the 1,000 stocks that we follow so closely, the valuations are still going down overall. So it just means that certain sectors are still doing well and some are doing poor enough that it's dragging the rest of it down. And this is something that we're watching. In the model risk tolerance, it doesn't get really confident to go all into stocks and really be fully allocated until the whole market starts to go, because that's when all rising tides lifts all boats. So again, just to know why it's going to stay pretty conservative, this is one of the main reasons. What we hold right now and have been holding has been done most of the heavy lifting for us is the SPHD. One of the key things that we really liked that was sort of a happenstance is the valuations of these particular stocks are still going up and positive. So that's a much more positive outlook than the whole market. This is, even though it's down a little bit month over month, still going up. So we feel like that'll be a nice place for us to stay for at least the next 6 to 12 months. So again, John's going to go over this individually in the portfolios, but it's now my time a little bit to gloat a little bit on how we've done. But this is our bond benchmark, AGG. It's a Barclays benchmark. It just is what all bond managers benchmark against. These are all our bond holdings. We're outperforming since April 8th by around 2.25%, so that's really nice. And the SPY, which is the S&P 500, we're outperforming by 3.25% there. So the whole portfolio is doing quite well, and I'm very happy to say that. But having said that, well, let's measure. If we're going to go performance, let's measure against everybody else. Let's be fair. So Bank of America comes out, I think twice a year, and they measure every type of manager, and they say whether or not they're beating the benchmark. Well, this half of the year, this second half, ever since they started collecting data, was the worst second half ever on record for managers. So we're active manager. That's what we're considered if we were in a huge database. And right now I'm very confident and proud to say we're in the top 20% of performers, even though it's a short amount of time, of active managers. So I'm very positive about this trend to continue going forward, just because we have superior technology and we are slavish to this algorithm, which we know has performed in many other settings in the past. So just a quick summary, and then I'll open it up to questions. Stocks overall are technically expensive, but when you compare them to bonds, which give you no yield or negative yield, they're actually cheap. So that's one of the reasons why they keep going up and could continue going up in the future. The biggest banks, which most people think is the biggest threat to the economy, have all passed stress tests, so that's a good thing to realize. Europe is just a mess. I think the European Union is a good idea, but just bad execution, and I expect more Brexit to happen. And I expect countries that leave the European Union to have immediate positive benefit, and it will increase the rate at which other countries leave. I don't know if you guys remember the pigs. Remember that was all the news, pigs, pigs, pigs. That didn't go away. That just went out of our mind. And if you think about it, a country like Spain, which has 20% unemployment, their country's bonds are trading at a higher value than the United States bonds. That doesn't make sense, right? It makes no sense. So this is the kind of thing that we're aware of, and we're going to keep, close ties on, and we will always have our risk management in place. Typically, election years going into the end of the year, on average, depending Democrat or Republican, is usually good for stocks, which is why the portfolios have reduced the cash, the models. We are very positive about this period of the year. The first year of any president, again, love these stats, I'm kind of a numbers nerd. From 1929 to 2014, the first year of presidency, which they call the honeymoon period, isn't necessarily good for stocks. So that's why the dividend focus and having preferred stocks, I think, is really good going forward. I do expect a shallow recession. Average recessions always, or on average, last around 18 months. Some of them are quicker. And, just staying true to dividends and value will yield great for us over time. So any questions about that? Tried to truncate it because I know there's a lot of data I threw at you guys and a lot to digest, but I think that's my job, is to help simplify some of these things that can be really mystified in the world of investing. Any questions?
Do you do anything with international stocks?
This software works anywhere. Like I can go and I can look at the entire Japanese stock market, I can look at European stock market, but right now, believe it or not, the US is the most favorable place to be for a lot of reasons. I mean, US dividends are the best dividends. They're in-house. I think if we were a more aggressive type of managing and we had models that would allow more volatility, a lot of those stocks probably would fit. But what's interesting is just emerging market stocks are more volatile, so they automatically just don't make it to our list. They may or may not be a good investment over the next 10 years, but in order to have a good compromise between volatility and returns, sometimes it's just not there. So, good question though. Yeah.
How was the Fed board established? Who does that?
The Fed?
Yeah.
So the Federal Reserve is a quasi-public-private organization. I mean, it was established by bankers in the 20s and sort of a consortium, somewhat like the OPEC. They have oversight, congressional oversight, and to some degree they are accountable in certain ways, but they're not audited.
How are the directors established by?
So they're in some type of sweetheart club. Nobody really understands how that works, but usually they pick a lot of key academics to be the face. So like Bernanke wrote a bunch of books about the Great Depression and taught at Harvard, so he had good headlines, right? But whether or not he knew anything, nobody knows.
They pick their own.
They pick their own, right. Well, what they do is sort of a sleight of hand is the president elects the chairman, but he only chooses from the 13 board of directors. So how they get there is beside me. I don't know. Good question, though. I mean, a lot of people aren't aware of their role. I mean, they've been a role in the United States finance and banking system for a really long time, and they don't really have any plan of going anywhere. So it's something we have to live with, but it's better to understand what they do and how they do it than to just demonize them and say, they're terrible, because in a lot of ways they do some good things. That's it for me. Any more questions? I'm glad to stick around up here and answer them. Other than that, thank you guys for coming. Yes?
I just started with the company Because
Okay.
I guess I'm used to, if I understood what the question was on the other persons here said, that you're not in mutual funds. Okay. So, how do I put this? How is, do you have a fund for like JCN?
Not yet. That's a good question. But essentially, in the sense of what a mutual fund does, we do the same thing. What they do is they buy a basket of stocks, and then you buy a share in their company. And then when your account goes up or down, it's actually mirroring the stocks that go up and down. And so there's the layer between you and the stock, right? So we directly invest in the market. We don't use a fund or basket of or a mutual fund. We do use what's called ETF, exchange traded fund, and these are just much more efficient vehicles to buy groups of stocks. But essentially, no, we don't have mutual funds, and in a lot of ways, we are our own private JCN, not technically a fund, but we operate very, very similar to that. Yes.
Share with her what the performance of mutual funds are.
So, kind of the dirty secret in the mutual fund world is 99% of them, or almost 100% of them, over a long period of time, do not beat the S&P 500. And there's a lot of reasons behind that. Inefficiencies, it's kind of a dated model, but that's really what we're aware of is if you invest in a mutual fund, the chances of beating the benchmark really aren't there. So our model is designed to beat the benchmark, either in taking less risk and getting the same return, or taking equivalent risk and getting much higher return. Does that make sense? We could talk about a little bit more when you come in. We can.
One thing that a money market mutual fund does, they have a strategy.
Right.
And it's not like our strategy.
Right.
And like they said, most of the time you follow a mutual, a money market mutual fund, it's not going to make the money that the market does. But you're locked into their philosophy of what they're buying and what they're selling and what they're making money on.
Right.
And you have no idea what that might be. Whereas here, we see the strategy we have is being implemented.
Yeah, it's a much more close-knit process, and that's what we're here for, to educate you, slowly but surely.
Talking about, when you say triggers, it's not like you're watching the computers 24 hours a day.
No, the
So
computers
you have
do it all for
a
me.
system in place to
Right.
give you a cue as to when you should look at certain things.
Absolutely. It's an algorithm, as anything in the world is today. Self-driving cars, iPhone is full of algorithms. It's just a computer program. Ours is a private proprietary program we had built for us. It's actually hosted securely in 2 different locations. So there's a fail-safe to it. So it's actually backed up, extremely well secure. And it's designed for our goal. So our goal might not be the same as another investment house's goal or another type of investor. We have very specific limitations on what we want to experience in our investing. So that's why we had it built for us.
Well, mutual funds have 4 levels of fees. They only have to disclose 1. So the management fee is disclosed, but all the transactions, the taxes, and distribution, they incur those. They don't have to. It's disclosed in the prospectus. It's not disclosed in the sales literature.
So I wrapped it up. If you had anything else to...
I think you probably had a whole lot. I'd like everybody to please give me your feedback on the forms there. If you happen not to be a client of ours and would like to visit with me, just indicate on the form there. One of my staff will reach out with you. This presentation will be on the website, so you'll be able to go back and view it at your leisure. And we have a JCW is a firm in downtown Baton Rouge that built our website. This young man here is 18 years old and run the whole show in the back. So give him a shout out if you get a chance to. But they're going to help us with getting information to you as well in a more clear manner. So we'll have next month, August 16th, I'm bringing Ed Slotted to Baton Rouge. And he'll be going to the Renaissance Hotel at 6 o'clock at night on Tuesday. You'll all get an email invitation to that as well, which I think will be a very, very timely event. So that'll serve as our as our August Speakers Bureau. And then we'll finish the year out probably with some tax planning topics, year-end tax planning topics as well. I think that, that's one thing I would say, that we're going to have a lot of change here in the next few months. And I do think tax-wise, it's going to be diametrically different. I think you're going to see a huge difference depending on who wins, what taxes will be.
What did you say, August?
16th.
It was full and some stuff leaked out.
That's okay. We'll sweep it up for you. August 16th.
And what is it?
Ed Slott, I'm bringing him to Baton Rouge again to speak. But one thing I think you're going to see is that some of the, we take things for granted, such as the tax rules and laws. Man, they change all the time. They change at a precipitous pace, and so back in 2010, they changed the law as it pertains to Roth contributions and conversions dramatically, and there's a lot of talk about that changing. So for most of y'all, we've already done some Roth conversions and some tax planning. I think it's funny. Some of you in this room had a painful time doing it, but I think everybody I know is very happy they've done it at that point in time. So that's not an investment thing, but it's a way you can